Most people invest backwards, not because they're lazy, not because they're unintelligent, but because they start with the wrong question. The first question most people ask is, what stock should I buy? That single question causes more long-term damage than almost anything else in investing, because smart investing doesn't start with picking stocks. It starts with structure, and when you get the order wrong, even good decisions lead to bad outcomes. Let's break this down. Most investors focus on what's exciting: hot stocks, market predictions, breaking news, timing the next big move. It feels productive, it feels smart, but it's backwards, because returns don't come from activity. They come from behavior, time, and consistency. When people invest backwards, they chase returns first and think about risk later. They react to headlines. They jump in late. They panic early. Not because the market is unfair, but because their approach has no foundation. The smarter way to invest starts with something far less exciting: time. Before you think about stocks, funds, or strategies, you need to understand your time horizon. How long can this money stay invested? 5 years, 10 years, 30 years. Time determines everything. It determines how much risk you can take. It determines how much volatility you can tolerate. It determines what types of investments even make sense. Without time on your side, no strategy works consistently. But most people skip this step entirely. They invest short-term money with long-term expectations, and that's where problems begin. After time comes risk, not the kind of risk people talk about online. Real risk. Risk isn't volatility. Risk isn't short-term losses. Risk is being forced to sell at the wrong time. Risk is needing money when markets are down. Risk is investing in something you don't understand and abandoning it when emotions take over. Smart investors decide how much risk they can handle before they ever choose an investment. Because risk tolerance isn't about math, it's about behavior. If you panic when markets fall, your portfolio doesn't matter. If you constantly second-guess yourself, returns don't matter. The best investment is the one you can stick with. Once time and risk are clear, then comes diversification. This is where most people think they're being smart. They buy a few different stocks and call it diversification. But real diversification isn't about quantity, it's about exposure. Different companies, different industries, different outcomes. Diversification exists for one reason: so that no single mistake can destroy your progress. Smart investors don't try to be right all the time. They design systems that survive being wrong. Only after time, risk, and diversification are clear does investment selection finally matter. And here's the part most people don't want to hear. What you invest in matters less than how you behave. Consistency beats brilliance. A simple strategy followed for decades beats a complex one abandoned after months. Most investors don't underperform because they chose bad investments. They underperform because they changed plans too often. They overreacted. They overtraded. They lost patience. Doing nothing sounds easy, but doing nothing during uncertainty is one of the hardest skills in investing. The smarter approach isn't exciting. It doesn't make headlines. It doesn't feel impressive, but it works. You decide your time horizon. You choose a level of risk you can live with. You diversify to protect against mistakes. And you stay consistent. That's it. No constant adjustments. No chasing trends. No reacting to noise. Most people invest backwards because they want certainty in an uncertain system. But markets don't reward certainty. They reward patience. They reward discipline. They reward people who understand that investing isn't about being right this year. It's about staying invested long enough for time to do the heavy lifting. You don't need to be smarter than the market. You don't need perfect timing. You don't need inside information. You just need to stop fighting the process. Most people invest backwards. The smarter way is quieter, slower, less emotional, and that's exactly why it works.